If you have more than $25,000 sitting in a single checking or savings account right now, you are losing money in 3 separate ways at the exact same time. And the most dangerous one has nothing to do with overspending, bad investments, or the stock market. It's a federal reporting system that your bank is already running on your account, and the law actually forbids them from telling you about it. The other 2 are quieter, but they're draining your purchasing power every single month while your balance just sits there, looking perfectly fine on the screen. Here's what I need you to understand before we go any further. Your bank earns money while your money sits idle. That is the business model. That incentive has never changed, and it never will. Which means there is no version of this conversation your bank will ever start with you. Not your branch manager of 15 years, not the friendly teller, nobody. So I'm going to walk you through all 3 dangers, exactly how each one works, and then the 5 specific places careful people actually move their money to protect it, with the current 2026 numbers, because the rates have shifted recently and you need the real figures. And I want to tell you right at the top, every single one of these fixes can be done from your kitchen table in less time than it takes to drive to the bank. This is not complicated. The bank just benefits enormously from you believing that it is. Stay with me. By the end of this video, you'll know exactly what to do this week, step by step. The first danger is the one most people have heard about and almost nobody actually understands. Under the Bank Secrecy Act of 1970, every financial institution in the United States is required by law to file a currency transaction report anytime. A customer makes a cash transaction exceeding $10,000 in a single business day. That report is filed on FinCEN Form 112 and goes directly to the Financial Crimes Enforcement Network, a bureau inside the U.S. Treasury Department. Your bank files it. You don't sign anything. You will never see a copy, and the bank is legally prohibited from telling you it was filed. That report contains your full legal name, your social security number, your date of birth, your home address, the exact amount, and the time of the transaction down to the minute. It sits in a federal database shared between FinCEN, the IRS Criminal Investigation Division, the DEA, the Department of Homeland Security, and hundreds of other federal, state, and local agencies. Once your name is in that database, it stays there for years, and every future transaction is cross-referenced against your history. But here's what most people don't realize. It does not stop at cash transactions. The software your bank runs is watching your balance and your habits continuously, looking for anything that breaks your normal pattern. A sudden large deposit, a sudden large withdrawal, money moving in a way it hasn't moved before. You don't have to do anything wrong to get flagged. You only have to do something different. And the bigger the pile sitting in that one account, the more attention it draws. Now here's the part that costs people everything. When most people hear about the $10,000 threshold for the first time, they have the same instinct. They think, okay, if $10,000 triggers a report, I'll just deposit $9,000 or break it into smaller amounts across a few days. That instinct has a name. It's called structuring. And under Title 31, United States Code, Section 5324, structuring is a federal felony. Not a fine, not a warning. A federal crime carrying up to 5 years in federal prison and forfeiture of the entire amount, even if every single dollar of that money is completely legal. Let me tell you about Carol Hinders. She ran a restaurant in Iowa for 38 years and made deposits below $10,000 because her insurance policy capped how much cash she could keep on the premises. The IRS seized her entire account, $33,000 in operating capital, with no criminal charges ever filed. It took 2 years of litigation and a pro bono law firm to get it back. Carol did nothing wrong. She never committed fraud. She made deposits in a pattern the software recognized, and the government took her money. Now there's an important legal protection here. In 1994, the Supreme Court ruled in Ratzlaff versus United States that the government must prove you knew the reporting requirement existed and that structuring itself was illegal. But here's the thing. If you're watching this video, you now know both of those things, so do not ever try to dodge the threshold by breaking up deposits. The simplest, safest way to reduce this entire category of exposure is to just stop keeping so much money sitting in the one place that's doing all the watching. The second danger requires no government report. It's happening to every account automatically, every single month, whether you do anything or not. Here's the math with current numbers. The national average savings account rate right now is 0.38%. The top high-yield accounts earn roughly 10 times that. Read that again. The average American savings account is paying 0.38%, less than half of 1%. Many of the largest national banks, JP Morgan Chase, Bank of America, and US Bank, pay an APY of just 0.01% on their savings accounts. 1/100th of 1% on your money, while inflation runs somewhere around 3 to 4%. Let me show you what that does. If you have $50,000 sitting in a standard savings account paying basically nothing, and inflation is running at 4%, you are losing approximately $2,000 in real purchasing power every single year. Not from a withdrawal, not from a fee, not from any mistake, simply from sitting there. Now here's the part that should genuinely make you angry. Your bank is taking your money, the money sitting in that account paying you 0.01%, and lending it back out to other people at 7%, 8%, 9% on mortgages, car loans, and credit cards, and paying you back essentially nothing. That is not an accident. That is the entire business model. Your money is doing all the work, and the bank is keeping virtually all of the reward. If you're carrying $80,000 or $100,000 in a traditional savings account, you are quietly losing thousands of dollars in real purchasing power every year, while the bank profits off the exact same dollars. One account decision recovers most of that. We're going to get to exactly which one. Right now, before we go further, open your account, not last month's statement, the actual balance today and the actual interest rate today. Look at both numbers, because what comes next depends entirely on where those numbers land. The third danger is the one that catches the people who did everything right. FDIC insurance covers $250,000 per person, per institution. And I need you to hear the specific wording there. It is not per account, it is per institution. A retiree with a checking account, on a savings account, and 2 CDs all at the same bank does not have 4 separately insured accounts. She has one covered pool, capped at $250,000 total. Any amount above that cap at a single institution is uninsured. If that bank fails, the excess is not guaranteed. Now, people think bank failures are something from their grandparents' era. They are not. In 2023, this country saw 3 of the largest bank failures in its entire history within a span of a few weeks. Silicon Valley Bank, Signature Bank, First Republic. The people who were under the $250,000 limit were made whole. The people who were over the limit had to wait and worry and hope. You never want your life savings to depend on hope when staying fully protected is this easy to arrange. And here's who falls into this gap. It's not reckless people. It's careful savers who consolidated their accounts for convenience, often after a major life event, and simply never ran the actual numbers. Let me tell you about Patricia. She's 71, a retired hospital administrator in Baton Rouge. After her husband passed, she consolidated 3 accounts into one bank for simplicity. The combined balance reached $310,000. Patricia was meticulous. She kept every statement. She filed every form on time. 6 months after consolidating, she learned that $60,000 of her savings had no federal protection at all. The bank never flagged it. Patricia did nothing wrong. The FDIC has a free calculator on their website. Nobody told her to use it. If you've saved diligently over decades, this is the gap that can wipe out years of careful work in a single bank failure. And it's completely avoidable. So here's the question you've been waiting for. How much is too much to keep in a regular account? The honest answer that careful financial planners give is this. Keep 3 to 6 months of your regular living expenses in your checking and everyday savings, and not much more than that. For most retirees, that lands somewhere between $15,000 and $25,000. That's your cushion, your emergency money, the cash you can reach in a moment. Everything above that number does not belong in an account that's watching it, shrinking it, and barely protecting it. Everything above that number should be moved somewhere better. Here are the 5 places careful people actually move it, with current 2026 rates. Number 1, a high-yield savings account. These are real, fully FDIC-insured savings accounts, usually at online banks that don't pay for a branch on Main Street, so they pass those savings to you in interest. As of June 2026, the best high-yield savings accounts are paying up to 5.08% APY, with many solid options in the 4% range. That is roughly 10 times, sometimes more, what your regular bank is paying you on the very same money with the very same federal insurance protecting every dollar. The money stays completely liquid. You can move it back to checking in 1 to 2 business days. Opening one takes about 10 minutes. This is the minimum correction, and it's the one most people should make first. One note from this week's data. High-yield savings rates are trending slightly downward as of June 2026, and some banks have so much demand they've temporarily stopped accepting new applications. So if you're going to do this, sooner is better than later while the rates are still elevated. Number 2, Treasury bills. A Treasury bill is a short-term loan you make directly to the United States government. It carries essentially no institutional default risk. You buy them directly through treasurydirect.gov, and current short-term rates are competitive with the best savings accounts. Here's what most people don't know. The interest on a Treasury bill is exempt from state and local income taxes. If you live in a state with income tax, a Treasury bill can quietly put more money in your pocket than a high-yield savings account paying the same headline rate. You can ladder them to mature every few weeks, so you always have money coming available. Number 3, Series I savings bonds. These are built for exactly this kind of environment because the interest rate adjusts along with the cost of living. By design, your money doesn't lose its buying power the way it does sitting in a regular account. You buy them from the same government website, up to $10,000 per person each year. The one rule, you need to leave the money in for at least a year. So this is for savings you won't need right away, not your emergency cushion. Number 4, a CD ladder. Instead of locking all your money into a single certificate of deposit, you split it across staggered terms, 3 months, 6 months, 12 months. As each one matures, you either use it or reinvest at current rates. You capture higher yields without giving up access. And if you buy them through a brokerage account, you can shop hundreds of banks at once, pick the best rates, and spread your money across multiple institutions so every dollar stays under the $250,000 insurance cap. Number 5, a money market fund. This is not the same as a money market account at your local bank. A money market fund held inside an investment account owns very short-term government-backed debt, and it currently pays in the range of 4 to 5%. Completely liquid, no lockup, no penalties. For a retiree with a larger amount to park, it's one of the simplest and most flexible options available. Here's exactly what to do this week. 5 steps. Step 1, find your current interest rate. Log into your account today, not last month's statement, and locate the actual annual percentage yield on every account you hold. Write it down. If it says 0.21% or 0.38%, you've just confirmed the problem. Step 2, calculate your per institution exposure. Add up every balance you hold at each bank separately. If any single institution holds more than $250,000 of your money, you have uninsured funds right now, today. Step 3, open a high-yield savings account. Search for high-yield savings account comparisons for 2026 on any major financial news site, and choose an FDIC-insured institution paying at least 4%. Verify the FDIC membership on the FDIC website before you deposit $1. Step 4, move the excess. Transfer anything above your 3 to 6 month liquidity cushion into a Treasury bill or CD ladder through treasurydirect.gov or a brokerage account. Step 5, verify your FDIC coverage. Use the FDIC's free electronic deposit insurance estimator at FDIC.gov to confirm every dollar you have is protected. It takes about 5 minutes, and it's the single most reassuring thing you can do for your savings. That's the whole plan. 5 steps. Most of it can be done from home this afternoon. Let me give you a few honest cautions, because I don't want you to walk away thinking any of this is risk-free or one-size-fits-all. High-yield savings rates are variable. They can and do change. The Federal Reserve left rates unchanged at its June 17, 2026 meeting, keeping the target range between 3.50% and 3.75%, the fourth no-change decision of 2026. If the Fed eventually cuts rates, these savings yields will come down too. The 4 to 5% you see today may not be there in a year. That's not a reason to avoid them. It's a reason to take advantage while the rates are good. Series. I-bonds and CDs lock up your money. Don't put your emergency cushion in anything with a lockup period. The whole point of the 3 to 6 month cushion is that you can reach it instantly. And none of this is personalized financial advice. Your specific situation, your tax bracket, your state, your income needs, your other assets matters. If you have a genuinely large or complicated estate, a fee-only fiduciary financial advisor is worth the consultation. But the basic moves I've described here are about reducing risk and getting paid properly. They are not about chasing returns or taking on market exposure. You are not taking on risk by doing this. You are taking risk off the table. The inflation risk, the FDIC gap risk, and the unwanted attention risk, and getting paid properly for the first time in years. Here's the thread that runs through all 3 of these dangers. Keeping a large pile of money in a normal bank account does 3 things to you at once. It puts you under a watchful federal eye you never agreed to. It lets inflation quietly eat your savings while the bank pays you almost nothing. And above a certain line, it leaves your money completely unprotected if the bank fails. The fix for all 3 is the same simple move. Keep a few months of expenses in your everyday account and move everything above that into accounts that are safer, fully protected, and actually paying you something real. The IRS is never going to call you and explain how to draw less of its attention. Your bank is certainly never going to call you and tell you how to earn 10 times more somewhere else, because that's money it loses the moment you move it. The only person who can make this decision is you. And the move itself is far, far simpler than the bank wants you to believe. Most of these accounts can be opened from home in less time than it takes to drive to the branch. So this week, do steps 1 and 2 at minimum. Find your rate. Calculate your per institution exposure. Just knowing those 2 numbers puts you ahead of almost everyone. If this was useful, share it with one person you care about who's been keeping their life savings in a single account earning 0.01%. That one share might recover thousands of dollars for them this year, money the bank was quietly keeping.